what they've been doing all year. They print the hot number on the front end, and then they revise the number the next 2 or 3 months. So my guess is that they probably revised previous months again, to the point of why? Why do you want to cause breakage?
Strategists at Bank of America Corporation recently acquired historical data from the U.S. bond market dating back to the nation's inception. The data reveals an unprecedented 3-year period of sustained losses, which raises questions about the accuracy of figures from the early post-colonial years. It's challenging to gauge how frequently bonds were traded during events like the War of 1812. Nevertheless, the statistics indicating over 236 years of historically poor performance are striking. They serve as a stark reminder of the extensive financial turmoil following an unexpected inflation shock and interest rate surge. This upheaval proved severe enough to bring down not only Silicon Valley Bank but also 3 other regional lenders this year, forcing policymakers in Washington to intervene and provide support. Mark Yusko attributes these challenges to past policy decisions and discusses various economic slowdown indicators. The magnitude of the pain rippling through the financial world in the aftermath of the inflation shock and interest rate surge underscores the need for a comprehensive reevaluation of economic policies. The data paints a concerning picture of the market's recent performance, prompting a closer look at historical trading patterns and policy decisions that have led to the current financial challenges.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
This is the quote-unquote risk-free asset. Now, okay, long-duration bonds are not risk-free.
Right.
Well, but treasuries are not, supposed to default. But what people are getting a quick lesson in here is what happens with duration when interest rates normalize. And I use that term very intentionally in that, we had, I think, stupid, like a better term, policy for way too long with this whole QE, zero, ZERP kind of, bail out the banks fiasco. But here's the problem, right? Is I don't know if you have the chart or not, but the CDS, credit default swaps on banks, have blown out. And there's going to be a whole bunch of banks floating to the surface, like dead. And like dynamiting a river, right? The fish just float to the top. And it's ugly. And basically that was caused by, again, idiotic in hindsight, actually in foresight, it was idiotic, plan where you forced the banks to borrow from the Fed at zero and buy treasuries. Right? That was the plan because there were no buyers of treasuries and they wanted to do this MMT thing and this big fiscal spend. And so, okay, who's going to buy the bonds? Well, Japanese aren't buying them. The Russians aren't buying them. So, okay, you bank, you buy them. And it was free money for a long time. Borrow at 0, invest at 3, lever up 10 times. Love it. Okay, now rates go from 0 to 5. Oh shit. I got big losses. And we saw SVB. Well, now it's beyond SVB. I mean, regional banks all over this fine country of ours are about to just get obliterated. And then what happens? And this is the part that I don't want to be too alarmist and too scary, but if they then can't buy, who's going to buy all the bonds? Because I think what has happened in the past month is the bond market's like, well, shit, there's no one to buy my stuff. So I got to offer higher rates to clear the market. I mean, that's what it feels like to me.
A robust job market might spell trouble for the stock market if current trends persist. Friday's upcoming non-farm payrolls report is poised to present a significant challenge for Wall Street. This follows a week of unease concerning the surprisingly strong labor market. The concern lies in the possibility that the Federal Reserve, should the tight labor market persist, will maintain high interest rates, potentially endangering the U.S. economy during a crucial juncture. You may be wondering about the significance of non-farm payrolls and their impact on everyday life. Non-farm payrolls encompass all U.S. workers except for those in specific categories such as farm workers, private household employees, nonprofit organization workers, and government employees. Every month, The U.S. Department of Labor releases a report detailing the number of non-farm payroll jobs gained or lost, a pivotal indicator for the overall state of the nation's economy. A substantial increase indicates economic growth, while a significant decrease may signify an economic downturn. Investors and policymakers closely monitor this data to assess the economy's trajectory. Now, let's dive into the video as Yusko delves into the concept of the Santa Claus rally. It might sound intriguing, so sit up and listen to what he has to say.
We peaked in July. So it peaked July 28th, and we've given back almost half, not quite half, almost half of the gains for the year. Could we go all the way back to zero for the year? Yeah, we could. Everybody said, oh no, the Santa Claus rally is coming. The Santa Claus rally exists in years where you have big losses in certain sectors, and there's a rebalancing, and it usually happens in October. So October 31st, or I'm sorry, it happens in November. So October 31st is the deadline for mutual funds to make sales for the current year. It used to be 12/31, they moved it back to 10/31. And so what happens every year is, it used to be the last week of October, and then some people tried to game it, and they did the third week of October, and then some do the second. So starting, around next week, people will start selling the losers. They have to wait 30 days to avoid a wash sale, and then they buy them back. And that used to happen the last week of December into January, and there was something called the January effect. So small cap stocks and the things that had performed poorly the previous year had this big face melting rally in January. It's called the January effect. And then it disappeared when they changed the law and it moved to November. And that's what they call the Santa Claus rally, because it happens toward the Thanksgiving time into Christmas time. And everyone's, oh, this is great. Like, well, it only works when there is a dislocation in some segment of the market that people can rotate into in these big giant mutual funds. In a year like this year, where everything's up or flat, so you got most things are flat, and you got the Magnificent Seven up, what's going to get sold to tax loss harvest? Nothing. And then what are you going to buy back in November? Nothing. So I just don't think there's any impetus for the Santa Claus rally or the January or the November effect, I guess now it's called. And so I think what we have now is we have no tailwind, and we have increasing headwinds, particularly this interest rate thing. It's possible. I'm not predicting this. I'm not saying it's going to. It's possible that they've lost control of the long end. Right? It's possible. And they don't really control the long end like they do the short end, where they can, change rates. But in theory, you lasso the long end with the short end, and you kind of hold it, up or down but it's possible that they've lost it. And the supply and demand problem is going to overwhelm the market. And there was somebody who was Ron, what's the guy? He's on CNBC. He's got the glasses. Oh God, what's his name? It's not DeSantis, right? That's the political guy, but whatever, Santori. Anyway, so he was saying in a segment that rates could go to 13%. I'm like, okay, why is he doing that? Is that a talking point? Has he been told to say that? Is that just an extrapolation of the current trend? I mean, what? That was weird. That to me felt like what you do with propaganda, right? You put something way out extreme to seed the idea, and then you start repeating it.
The excitement among investors regarding AI's potential to enhance productivity and usher in a new era of growth played a pivotal role in the stock market's rebound from the severe drop it experienced in 2020. This recovery occurred despite the Federal Reserve's decision to raise interest rates to combat inflation. The S&P 500 surged by approximately 20%, briefly touching 4,600 by the end of July this year. For Ed Yardin, the founder of Yardin Research, this resurgence in the stock market was expected but came ahead of schedule, indicating a looming short-term setback. Yardin Research anticipated that the S&P 500 index might retreat to its 200-day moving average, currently hovering around 4,200. The veteran investment strategist, economist, and former Fed official noted this in a Sunday report. True to their analysis, the S&P 500 has since retraced its steps, dropping by approximately 7% to reach 4,280 by midday on Monday. Yarden anticipates the index could potentially reach the forecasted 4,200 level during October. However, he foresees a subsequent resurgence, suggesting the possibility of a Santa Claus rally, propelling the index back to 4,600 or a nearby level. This projection is contingent on the absence of unforeseen factors like an extended auto strike, a government shutdown, or unexpected credit losses at banks. Furthermore, Yarden's optimism extends to the third-quarter earnings season, which he believes will surpass widespread expectations. He predicts that S&P 500 operating earnings per share will reach a record high by year-end. While the prospect of a Santa Claus rally looks promising, it's always important to consider contingency plans in case the market behaves differently than anticipated. Your thoughts and strategies for such scenarios are welcome. Please share them in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.